Yeah, it's post-Brexit finance time. The City of London called in a report on Thursday for a new council which would allow Britain's financial sector to drive through big moves needed to boost the economy by £225 billion by 2030 and beyond. Britain is implementing a range of financial reforms after its exit from the European Union, which raised concerns about London's global competitiveness, as chunks of stock and derivatives trading, along with senior bankers, moved to the continent. We need to be more strategic as financial and professional services, just as some of our competing financial centers like Singapore, which have medium and long-term strategies. That was said by the City of London Mayor Nicholas Lyons, and he told this to Reuters. It would now be time to follow up systematically through a more formalized strategy with clear timelines and targets to ensure that momentum is maintained, as the joint report with consultant group Oliver Wyman said. The Council, if agreed, would be chaired by the Finance Ministry with industry officials and regulators as members. The report will be discussed with the main political parties at their upcoming conferences, perhaps their last before a general election expected next year. We want to get all the political parties to say yes, we can see where this is coming from, we can support it, Lyons said. The 8 big moves outlined in the report largely built on initiatives already underway, such as freeing up capital from insurers by easing their Solvency II capital rules and from pension funds to invest in infrastructure and growth companies. A council could make sure that regulators implement Solvency II changes and not row back, as Lyons put it, adding that he was confident the recommendations will be listened to by government and the main opposition Labour Party. They are in the lead for the next election at the moment. If we don't do it, the city will continue to be perfectly successful. But if we do it, I think we can be spectacularly successful, Lyons said. But I say easing Solvency II bears high risks. We know what happened during the financial crisis. Solvency II was introduced in 2009 in response to the financial crisis of 2008. The crisis revealed that many insurance companies were not adequately capitalized to meet their obligations, and this led to concerns about the stability of the insurance industry and the protection of the policyholders. Solvency II was designed to address these concerns by strengthening the prudential regulation of insurance companies. The regulation requires insurance companies to hold more capital, to disclose more information about their financial condition, and to improve their risk management practices. The introduction of Solvency II has been controversial. Some have argued that the regulation is too complex and burdensome and that it could stifle innovation in the insurance industry. However, others have argued that the regulation is necessary to protect policyholders and beneficiaries and to promote a sound and stable insurance market, and I am on that side. Ultimately, the success of Solvency II will depend on how it's implemented and enforced. If the regulation is implemented effectively, it will help to prevent future financial crises and protect policyholders and beneficiaries. And there are some reasons why Solvency II was introduced. To address the weakness of the Solvency I regime, which was the previous prudential framework for insurance companies in the European Union. To strengthen the protection of the policyholders and the beneficiaries, which is very important from my point of view. And to promote transparency and comparability in the insurance market. And to create a level playing field for insurance companies in the EU. And especially to reduce systemic risk in the financial system. Solvency II is a comprehensive and complex regulation, but it is essential to protect policyholders and beneficiaries and to promote a sound and stable insurance market in the EU. As I said, it's a set of regulations that govern the prudential supervision of insurance and reinsurance undertakings in the European Union. It was indeed introduced in 2009 and came into full effect in 2016. The aim of Solvency II is to ensure the long-term solvency of insurance companies and to protect policyholders and beneficiaries. Solvency II is based on a risk-based approach, which means that the amount of capital that an insurance company must hold depends on the risks it faces. And the risks are divided into three categories. There is the market risk, the risk that the value of an insurance company's assets will decrease due to changes in market prices. Then there's the credit risk, the risk that an insurance company will not be able to collect all of the premiums it is owed. And the operational risk, that's the risk of losses caused by internal or external events such as fraud or IT failures. To calculate the amount of capital it needs to hold, an insurance company must use a complex formula that takes into account all of the risks it faces. The formula is based on the company's assets, liabilities, and risk profile. In addition to the quantitative requirements, Solvency II also has qualitative requirements. These requirements are designed to ensure that insurance companies have sound governance and risk management practices. Indeed, it is a complex and demanding regulation, but it is essential to protect policyholders and beneficiaries. The regulation has been praised by many for its comprehensiveness and rigor. However, as I said, it's also been criticized for being too complex. But of course, some people that want to hide something can't. It is a risk-based capital regime, and it requires insurance companies to hold capital that is sufficient to cover their risks. And there are these three pillars as well, not only three risks. Pillar 1 is a quantitative calculation of capital requirements. Pillar 2 is a supervisory review process. And Pillar 3 imposes reporting and transparency requirements. Solvency II is a constantly evolving regulation. The European Insurance and Occupational Pensions Authority, the EU's insurance regulator, is responsible for updating and interpreting the regulation. Solvency II is important because it ensures the long-term solvency of insurance companies and indeed protects policyholders and beneficiaries. The regulation does this by requiring insurance companies to do exactly what I told you in this video. And this helps to prevent insurance companies from becoming insolvent and unable to pay out claims. And Solvency II is also important because it promotes transparency and comparability in the insurance market. Because the regulation requires insurance companies to disclose detailed information about their financial condition and risk management practices. And this information helps policyholders to make informed decisions about their insurance choices. And in addition, Solvency II helps to create a level playing field for insurance companies in the EU. The regulation applies to all insurance companies operating in the EU, regardless of their size or nationality. And this helps to ensure that all insurance companies are subject to the same regulatory requirements. Some Brexiteers didn't like that very much, and hence Brexit. Overall, Solvency II is an important regulation that helps to protect policyholders and beneficiaries and to promote a sound and stable insurance market in the EU. As I already said, some of the Brexiteers were very interested in the insurance market, and if you listen carefully in the video, it came into effect in 2016. So when the Brexit referendum happened and the people demanding this referendum knew that it would come into full effect in that year. And of course, there were a lot of people that at that time had an interest to get out of the EU, to get rid of Solvency II, which hasn't happened yet. But now this government, which is still steered by a lot of right-wing Brexiteers, is planning to get away from the Solvency II rules. That might help those companies within Britain, and in other countries where they are working, but not within the EU. The British financial services sector that is working inside the EU will not benefit from this, because here they still have to follow those regulations for every customer in the EU. But we know the financial services sector is a major contributor to the UK economy. In 21, it contributed 173.6 million to the GDP, or 8.3% of the total economic output. And they employ more than 1 million people, or 3% of all jobs. And the City of London is still a major financial center. It's home to the Bank of England, the London Stock Exchange, and many other financial institutions. Although they had to move some stuff because of Brexit, because some operations had to move to the EU and some people had to move to the EU, not as much as everybody thought, but the transition periods are not over yet, and some of them have been extended. So that is not the end of the story yet for the financial market in London as well. And when euro clearing will finally be back in absolute EU hands, then we will definitely see some movement there as well, because euro clearing is still a lot in London, but that's only because of transitional periods that have been extended. I have to clearly say that some in the EU haven't done their homework, otherwise it would have moved already. But euro clearing belongs there where it comes from, into the EU. It's not acceptable that a third country is doing the euro clearing for the EU. And when this happens, and it will happen, even if they haven't done their homework properly, as we know from the other side in many cases, it will happen, and that will have a big impact. And the UK banking system already has suffered from Brexit. 44% of financial services firms have moved or are still planning to move some UK operations and staff to the EU. And this already has led to a loss of jobs and expertise in the UK banking sector. And there's more to follow. And the UK has lost its automatic access to the EU single market for financial services. And this means that UK banks now have to comply with more regulation and paperwork when doing business with EU clients. And this has made it more expensive and difficult for UK banks to operate in the EU. And as a result of these factors, the UK banking system has become less competitive and less attractive to foreign investment. And this will have a long-term negative effect on the UK economy. And this investment part is really important, and you could see it in a lot of different businesses in the UK that this absolutely happened since the referendum. And if you want to know more about Brexit or other UK politics, the next video is right here in the end screen. I'll see you there. I'll be back.